Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today we're going to be focusing on the second half of the series, the series name. We're going to be trading a long diagonal spread. This one's going to be a little bit shorter term than we've traded in the past, probably playing out in just a couple of months. It should be an interesting discussion. We're going to be setting that up using example charts. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see Life in the Fast Lane, Prakash, Lola, hello there, Janelle, David, Kevin, Carol, Ted, Noodlebrain, Frank, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy the presentation. The recordings are a great way to watch these webcasts. But if you'd like to be here in the live stream, this is a Thursday webcast series. We kick things off promptly at 11 Eastern time. We'd love to have you here in our live stream audience. And as a treat for our live stream audience members, my very good friend Brent Moores is going to be hanging out in the chats. He's going to be keeping an eye on any questions that come in. If I can't get to those questions, Brent's going to be addressing those. Thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite Schwab presenters on X. You can follow Brent there at Brent Moores CS. You can find me on X at Cameron May CS. And I've been providing an additional heads up. You can now connect with me as well on LinkedIn. So just look for Cameron May on LinkedIn. I'm the guy sitting in front of a castle. You'll know you found the right profile. If you reply to me on social media, I reply right back to you. It's a great place to connect. Now, there is one exception. If I happen to say something that's too hot to handle, I won't reply to that. But yeah, otherwise, if it's business, let's talk about it. Anyway, let's get into this. And as we do, of course, there are risks to consider. This is important information, so bear this information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's set an agenda for our time together today. First thing that we're going to be doing, as we typically do, is looking at the current positions in our paper money portfolio. This webcast is part of an ongoing series of discussions. So we have some example trades that we need to take a look at, see if there's anything that needs to be managed there. Then we'll take a peek at what's going on with the markets, see if there are any apparently important developments on the S&P, and then we're going to use that as a backdrop to set the stage for a discussion of trading diagonal spreads. We're going to be doing a long call diagonal spread today. We'll see if that turns out to be a good idea. We'll see if stocks start to find a floor here pretty soon, or if they continue to sell. Both of those could have important implications for this trade that we're planning. In any case, we'll make sure before we're done that we actually plan that trade out. We weigh the pros and the cons, and we're going to place that long call diagonal spread trade today. So let's go right to the Thinkorswim desktop platform. And we have three positions right now. So we do have a diagonal spread along with, I believe, a couple of long verticals. So let's have a look at the first one here. We have Johnson & Johnson, which is a long call vertical spread, bought the 190 calls, sold the 195 calls for the 19th of December. Still some time there on those contracts. 43 days left, but they're not doing well. Not doing well. Down about $1,350 on this position. So let's go have a look with this strike selection, 190 and 195. The preference is for the stock to climb above 195. It's doing quite the opposite at the moment. It's actually slipping down closer to 185. It's at about 186 right now. So let's go revisit the history of this trade. So we took this position back here on October 16th, bought the 190 calls in the money, sold the 195 calls out of the money with a preference for the stock to get above 195. It started in that direction for a couple of days, but since then it's been uncooperative. And we have a note right here to consider closing if this trend line breaks. So we might have an important decision here to make today. Because if you look at price at this moment, it seems to be right at that trend line. Has the trend line broken? Now, I want to throw that question out there, but also maybe some other considerations. We kind of have our blinders on at the moment, and that can be deliberate. But we're looking at a stock all by itself. However, can our stock also be influenced by broader trends in the markets? If the markets start to rally right as we exit this bearish or bullish position, might turn out to be some poor timing. Also, we're kind of in the thick of the holiday season, which historically has been bullish. Could that provide a bit of a tailwind despite things looking not quite so good right now? These are all things that the trader might consider, among other influences, right? And maybe I'll skip ahead a little bit here, have just a quick peek at the S&P 500 and maybe frame what we're discussing. And what some technicians might note is that as the S&P has been climbing through this great run up, of course, there have been times where we pulled back. We pulled back, we pulled back, and yet each time we've pulled back, it seems to bring us down to about this trend line here. So look at today's selling. Kind of interesting where that has positioned price on the S&P 500. Could this be a potential turning point in the S&P? Down, about 3% from those recent all-time highs. Jay Asunchi says, how much time till expiration? We have till December 16th, I believe those contracts were, or the 19th. Yeah, if you want to look at that, we have 43 days left on those contracts. So going back to our Johnson & Johnson, 43 days, the 19th of December. So is there time for a rally? Could be. If the markets decide to do that, if Johnson & Johnson decides to do that. We're not guaranteed. So what should we do? Trader has a number of options at their disposal, kind of literally speaking. We could close out some of the position. We have 10 contracts, maybe close out half. We could close it all out and just stop the bleeding at around $1,300, $1,400 lost. There's still about that much left that we could lose if this continues to spiral. On the other hand, there's much more upside potential if we can get a rally in these next 43 days. It's not looking highly probable at this point. We need to get from 186 all the way up to 195 to be in position for our maximum gain, and we only have until December 19th, 43 days to do it. What should we do? Eric says hold. We're awfully close, aren't we, Eric? We might be splitting hairs here with this technically, sitting right at a potential support on the S&P 500, leaning into the holidays. I think what we're going to decide to do here is, let's hold it, okay? Might regret that next week, but we're going to leave that position in place. Oops, I just accidentally reorganized let me just reorient those. There we go. Anyway, let's go to Tesla. And with Tesla, again, we have a long call vertical spread. This one's doing okay. It was doing a whole lot better yesterday. Bought the 400 calls, sold the 410s. We want to be above 410. Well, we're at 443. So why isn't this profitable? It's because, yes, we're above our strikes right now, but we're not as far above them as we once were. So if we go to Tesla, initiated this trade right here. So we started pretty much the first part of this candle. And we floated, we went up and down and up, and we're back down again. Still well above our two strikes, working our way toward that December expiration. This one, there are our strikes, the 400 and 410. We're in our maximum theoretical gain territory. Let's just leave that one alone and skip on to United Health. United Health is our long call diagonal spread, where we bought the 300 calls that have 2 years left on them. And we've been selling shorter term calls against that position. So the 300s haven't been doing great. Bought them for $92. They're worth $86. We're down about $6 on those contracts. Now we've sold the 380 calls for $265. Those are only worth about 42 cents. And we've actually closed out a previous profitable short call position as well. So let's have a look at UNH. Bought the 300 calls here on the evidence of an inverted head and shoulders, breaking that neckline, popping up here, entered the trade as we were coming back down and testing that neckline as a potential support. Sold the 360 short calls. We've closed those for a 320 profit. Sold the 380 short calls. Those we could possibly close for about a $2 and change profit right now. But look at this again. Consider closing. Notice I didn't say close if support breaks. I said consider closing if support breaks. We got to ask ourselves, have we definitively broken that support in the first place? Still kind of above this neckline. We're still above this sort of inside of the two shoulders, kind of in no man's land at the moment. Same scenario regarding the S&P 500, possibly at a support, could rise from here. Exiting bullish trades right at this moment might turn out to not be a great idea. Time is going to tell. We don't know. With this one, another thing that we could do, but we could consider rolling that 380 short call, because when we sold that, it was 265, 42 cents. I'm guessing there's pretty good spread between the bid and the ask on that short call. Let's go have a look at it. Go to our trade tab. Make sure that we're looking at UNH. Make sure we have the right expiration. The 380, that's only 40. It's only 5 cents on that spread. John, okay. Oh yeah, Dragon Rider says you're trying to stay away from emotional stocks, and John says you want to know which stocks are unemotional. Got me on that one. Anyway, what should we do? Should we close out the whole position? Should we maybe roll this one to possibly a larger premium? Maybe having to move that the strike price lower. What do we get for like a 360? Maybe a 360? Let's go see. Let's go to that trade tab again. We're not going to probably get a ton. That's not bad. Let's look at that. Maybe that 360 strike here. With our 380 worth 42 cents, we could possibly bring that down. Now this bring it down $20, agreeing to sell the shares for $20 less in order to maybe collect another 75 cents in premium, possibly. I don't know about that. I think what we'll do for this one, I'm just going to let that one go for another. Let's let it go for another week. It's still that short contract is way out of the money. There's still money to be made, though. 42 cents, still $42 left in that contract. I think with that one, we're just not going to make a change. So, decision made. Here's where this is what we would like to have happen between now and the next time we convene. It would be nice to see the stock start to rally again. That would help out this long call while leaving that short call out of the money. That would be ideal. We'll see if that plays out. Let's go have one more look at the S&P 500. Yeah, we're kind of selling in. We're trading near session lows, down about 1%, and that's right there at that support. For some traders, breaking that trend line, especially if we go on to make lower highs and lower lows, that could change the way that some technical traders approach the markets. But I'm going to go forward under this assumption, maybe just a recognition of the fact that rarely do the markets just go straight up. Even on their way up in a bull market, they tend to move up in stair-stepping cycles. Run up and pull back, and run up and pull back, and run up and pull back. And as tempting as it can be to say that this pullback is unique, it's the unicorn among the others, this is the one that's reversing the whole trend of the S&P 500. We don't know that yet. So as of this moment, it looks like just a proportionate pullback compared to previous ones. And let's say that our hypothetical trader thinks that maybe this is an opportunity to go add additional bullish positions to their portfolio. Again, time will tell if this is the right decision. But let's say that our theoretical trader here thinks that we're going to bump our feet against that price floor and start to rise again as we move toward that November expiration, maybe pulling back, working our way higher, moving in toward the December expiration, and maybe even further. So I'm going to be doing another bullish trade. We're going to be doing a long call diagonal spread. I would suspect we've got nearly 200 people watching. Not everybody knows what a long call diagonal spread, but it is. So in short, we buy a call option, and at the same time, we sell a short call option that has less time till expiration. So we are going to have two competing trades. I know it sounds a little bit counterintuitive, but I think it makes sense once we really understand the strategy. So let's use an example stock to set up a trade. And here's a stock that's not having a great morning. Let's look at what's going on with Amazon. What's happened with Amazon? The stock was really trending sideways for months. Then it got a pretty good earnings announcement that spiked it up. And I believe, let's look at some longer term charts. I think this was, all-time highs there. There we go. Let's go back to the 1-year chart. So finally, this earnings announcement spiked this up to all-time highs. And the enthusiasm continued into the next day after earnings. So the day of earnings, the day after earnings, and then, oh no, panic. Things are selling off. Is it possible? Is it conceivable that maybe just a lot of people made a lot of money in 3 days and there's some profit taking happening here? I'm going to use a Fibonacci tool. Fibonacci's are sometimes used to gauge potential support and resistance levels when there's a really strong move in one direction or the other. So I'm going to use our Fibonacci's, and I'm going to go right to the top of this earnings enthusiasm spike. Let's go right down to the day before that earnings. So this is sort of recognizing what these people just went through, the owners of shares went through in 3 days. The price spiked up, and there's been some profit taking, and this is kind of interesting. For those who trade using Fibonacci's like this, when there's a big run up and some profit taking starts, when is it typical to expect the profit taking to end and for price to resume the upward move if it does? Well, a typical assumption here is, and this doesn't always work out, but whatever distance was traveled, maybe a third to about a half of that is surrendered in the opposite direction. So that would actually take us back. So if we popped all the way from these lows to that high, we might sag back about a third to about a half of that distance, which would be right through here. That's interesting. The 50% is right in line with previous highs. And look where we find ourselves right now. Yeah. We're right in between the 61.8 and the 50% Fibonacci, representing maybe about a 1/3 to 1/2 retracement. If you think about it, this is the psychology of this. Kind of makes sense. If a bunch of people just made a lot of money very quickly, as they did, this literally went from $222 stock to a $258 stock. That was a 10% move in 3 days. That's a year's worth of productivity in an average stock portfolio in 3 days. So for some traders, they might just say, hey, that's good enough for me. I'm going to take all of my profits off the table, or I'm going to take some of my profits off the table. Now, not everybody does that. There are going to be investors here that are just thrilled that earnings seems to be going well, and they just hold on. So as long as this doesn't appear to turn into just pure panic selling, and not everyone who made money during this period seems to be selling off, it might just represent a new opportunity to some technical traders to get in on a very bullish stock. Kelly says, when you go out 60 days till expiration on these or so, is a plan to hold to a data expiration range while riding ups downs set by your risk tolerance or Yes, a good question, Kelly. And yes, the short answer to that question is yes. I'm going to try to cover that as we go through the rest of our presentation. But let's say that our trader just thinks, all right, so this is just profit taking. Boring, yawn, that's fine. It was expected. And their assumption is that sometime in the next few dollars, maybe we'll start to rise again. So I'm going to look to buy. I could just buy shares. Instead of buying the shares, though, we're going to buy a call and look for that to start making money if the stock starts to rise. Now, at the same time, though, we're going to diagonalize this. The harshest enemy of a call sometimes can be time decay. How can we get time decay working in our favor as a buyer? Well, maybe at the same time, we become a seller. So we're going to buy a call, and at the same time, we're going to sell a call that we think is just going to expire out of the money. And what we're going to do is use this recent peak as a way to potentially select which call to sell. Because if the stock gets some strength, it might take some time just to get back up to these previous highs. So let's buy a call, and we're going to sell a shorter term call that hopefully will expire before the stock can recover up to $260. Beer says, it's funny you said in the next few dollars instead of the next few days. That was very deliberate. Yep. Maybe our trader is just thinking, we don't know exactly when. It might be today that we bottom out. It might be tomorrow, it might be the next day. That might not be terribly interesting to the trader, as long as the stock doesn't continue to go down. Bottoming out at some time in the near future, if we give it enough time. The precise timing may not matter so much, but getting that reversal is what might matter. So here's going to be our trade. Pardon me. Let's go to our trade tab, and with the stock trading right around 244, let's go out sometime, because here's another thing that we might do. Let me zoom back out here, kind of skipping ahead just a little bit. One thing that the trader might do if they're using their fibs or just recent highs, that can inform where they might choose to sell the short option. But I also might want to get a gauge. Let me remove that drawing. We've seen this fib, so let's just remove that drawing. If the stock decides to start moving higher, how high might it go if it can get up above 260? What might be the next level of resistance? Well, there's not any obvious resistance out here. This would be in territory the stock has never visited before. Well, here's one technical approach that some traders might take, and that is we look at this channel that the stock was previously trading in, and assuming that there are some traders that are creatures of habit out there, if traders were happy to trade within a channel, between a support down here, a resistance looks like it was up around, around here. There was our previous channel. We might right-click on that channel that we've just drawn, duplicate that, and then go up to the top of this gap. That might help us gauge where the stock is possibly likely to go from here. It looks like maybe if we establish a channel of similar depth, similar volatility, similar trading range, and assuming that we're at or near lows, we don't know that for sure, but assuming we are, where could a more distant price target be? That might be up around 270. Not saying that we're going to go rocketing straight up there, but if we work our way higher and we give it a couple of months, maybe we can get up there. Now, Mary Burns says this is blue sky. Other than that, right? We're in uncharted waters here. So let's keep that in mind, that 270, recognizing it might take a couple of months. Obviously, buying a call that's going to expire tomorrow wouldn't give us any chance whatsoever to get up there. Buying a call that expires in a week, I guess I can't say any chance whatsoever. There'd be a tiny, tiny, tiny chance if something great happened today. In any case, a week might not be enough. A month, probably not enough. Let's give this a couple of months at least. So the contract we're going to buy, how about we go out here to the 16th of January, giving 71 days on the long contract to try to realize some of that upside potential if the stock decides to start going up toward 270. And this is going to be the first half of the first leg of our example trade. Our example strategy or our example trade, which is going to be a long haul diagonal. I'm going to go ahead and type in the word spread. I know that's wordy, but I'll explain what this is. But it starts with buying a long call. We're going to buy, as our example today, the 16th of January, with stock trading around 244. What some traders will do is they'll go in the money with their long contract. It's an initial effort to try to slow down time decay a little bit. How about for this one? We buy the 16th of January 240 call. That looks like that's trading for around 1680 and 1690. Let's call it 1685. If we were to just buy that call, and if the stock were to go running up to 270, yeah, that'd be great, because we'd have the right to buy a $270 stock for $240. That's part of what we'd like to see here. But we recognize the stock is unlikely to just go straight on up to 270. It's probably, even if it goes that direction, more likely to kind of stair step its way there. But at the same time, we're going to sell a contract that we think is just going to expire worthless, try to get time on our side. So let's go to a shorter term contract. What if we go to the 21st of November? And where did we think that original resistance was likely to be? Right up here around 260. So if we start to rally, we may still be below 260 on November 21st. Wonder how much we could get for that 260 contract. Maybe not much. We're going to see. $1.33, $1.37. Okay. There is some premium there. It's not a ton. I'm going to do it anyway. Let's sell the 21st of November 260 call. And looks like we might be able to get $1.33 for this. So here's what the trader who sets up this sort of a trade has in mind. It's sort of a double dipping approach. They're trying to make profits from the stock going up, but also profit from the stock not going up too far. So if our stock goes up, that's helping out our long call. But as long as it's still below $260, so look at that. That would give it $17 of upside wiggle room. As long as we're below 260 by the 21st of November, what happens to this call that we're selling? Well, that just expires worthless. So we get capital appreciation in the call that we bought, plus we collect a little income premium from the call that we sold. And, if things go according to plan, if we wind up somewhere between 243 and 260 on the 21st of November, this trade is doing what we're hoping it does. Now, the closer to 260, the better. But we have to recognize it's possible it may not work. If the stock continues to fall, this call takes some damage. And this one helps out a little bit, but not a ton. If the stock goes all the way up to 260 and continues through, well, now someone has the right to buy shares from us for 260, and they're worth more than that. We start to lose money on the 260, and it chips away at the performance of the 240. Still actually profitable trade overall. It's just not as profitable. Best case outcome is to get up close to 260. All right. Now that's known as a long call diagonal. So why do we call it a long call diagonal spread? Well, we bought a long option. Long just means we're buying something. And that's the option that carries the bulk of our attention in this trade, because we've invested $17 in that thing. This is a net debit trade. It's a long spread. It was constructed using calls, so it's a long call spread. It's a diagonal spread because there are two distinctions between the two options that we're trading. We have price and time. Buying a 240, selling a 260. So 240 here, 260 here, there is a distinction in price. There's also a distinction in time. Our 260 expires in November. Our 240 expires way out in January. So if we have price and time, if we draw a line between those two things, the way that I think about it, it kind of would make kind of a diagonal appearance. Noodle Brain says, how's that different to the poor man's covered call? There is no difference. Yeah, that's just another name that some people give to a diagonal spread. The concept there being, instead of buying a stock and selling a call against it, we're buying a long call. In other words, we're buying the right to buy a stock and then selling a call against it. And that buying the call costs less than buying the stock. So some people refer to it as the poor man's covered call. However, we have to recognize that it's a whole lot easier to lose the entire investment in a long call than it is to lose the entire investment in a long stock position. So they're not entirely the same strategy. They're similar in a lot of significant ways, but not exactly identical. Okay, so there's our trade. Long call diagonal spread. Pardon me. Still got the remnants of a cold hanging around. So where would we like to be? Just to help you visualize this, let's draw in a line right at 260, right over today's date. And I'm going to carry that out to the expiration for our short strike. So here's what we'd like to do. We'd like to see the stock go up toward that 260 strike, but to come up somewhat short. The ideal outcome would be to be at 259.99. We'd like to see that long call get as much benefit from price appreciation as possible, but still see that short call expire worthless. Now, we also have to recognize that when we're in a short call position, someone else has the right to buy shares from us, even if they're out of the money. Even if the stock isn't worth that much, now that actually would contribute to the potential profit or profitability of this trade, but it's still a possibility. We have to keep that in mind. Vic says, why do this in calls? Can we not do this using puts? So we could construct a long put diagonal spread, but that's typically a bearish strategy because puts, we have a preference for the stock to go down. Now, someone who thinks that this gap up is just, let's say they think it's, oh, this is an overreaction by shareholders. Amazon is about to go through a new rough patch going into the holidays or whatever their logic might be. I don't know. But if they think the stock is going to go down, maybe they do a long put diagonal spread. Good question. Let's see. Eva says, do you look at implied volatility before doing a diagonal spread? We can, but it doesn't play a massive role, really. Let's look at a couple of things. All right. So looking at volatility certainly plays a role in the pricing of options right now and in the future. So if we look at this short contract that we're considering selling, what is its vega? It has a vega of 12, which means if the volatility rises, that helps out buyers of this call. Well, we didn't buy that; we sold it. So if the volatility rises, that would hurt our call to the tune of about 12 cents, assuming a 1% increase in volatility. Well, if I go out here to the 16th of January, and I look at our 240 call, it has a vega of 42. So if the volatility rises, we get a bump for that long call at 42 cents. We take a hit of 12 cents. And so the net there would be a 30-cent net bump if volatility rises. So if what would the trader's preference here be for volatility direction then? If a bump gives us a boost of net 30 cents, and we probably would like to see volatility rising. Fortunately, we're kind of in between earnings, moving toward the next one. It's possible. There tends to be a tendency as we do that for volatility to rise. So could that be on the side of this trade? It could be. Not a guarantee, though. All right, let's see. Eva says, do you set up a stop on the November 260 call? That's a possibility. I'm not going to for this trade, but for example, if the stock really starts to rally, that actually is not a bad thing, right? That short call is possibly going up in price, but working toward expiration, as long as we're still below 260, maybe the trader still has patience to try to let this play out. So I think that an argument could be made to not put a stop on, because the assumption is maybe the value of that short call goes up for a little while before the time decay can really kick in. But it could be done. Feynman says, if the short call approaches 260 and if the trader's trying not to get assigned, could they then choose to roll up? Rolling is a possibility. Rolling, okay, literally just means, hey, let's get out of the contract that we're in and use the same order ticket to get into a new contract. That's rolling. Be aware, though, that can, among other things, that can introduce additional commissions. It will. Yeah. In most scenarios, we use it when trading options. So we also need to be aware that just rolling, we might be taking a loss on the short that we're exiting, and the new one might not go any better. So it doesn't fix anything. We just have to see how it plays out. Yeah, but Feynman, that's a possibility, and we might even talk about that if that scenario arises as we approach that expiration. But for now, let's just keep it fairly straightforward. I'm going to go ahead with just this diagonal spread, but let's try to visualize how the trader might really hope to see this entire thing play out. So our contract this contract doesn't expire until the 16th of January. I'm going to add a little bit more space. Let's change our right expansion settings. Let's go out like 65 days. Click apply. Is that far enough? Oh yeah, that's way more than I need. What I wanted to be able to see was this 16th of January expiration, because that's when our long expires. So look at that. Do you see the line there at 240? That's when that 240 contract expires, 16th of January. So really, what the trader might be hoping for is the stock to run up, pull back. As it pulls back, maybe we sell another short call. If it runs up again, pulls back, we might sell another short call. We might be able to sell a short call here, sell a short call here, maybe even sell another one. Yep. Creating diagonal spreads along the way, or additional diagonal spreads. Getting income along the way, along with our potential price appreciation. All of those are just potential, because we'll just have to see if that's how things play out. But let's go place our trade. Let's go to our, we're here at the 16th of January already, so let's just do this. Doesn't really matter the order in which we do this if we're putting them all on the same order ticket. But here's a quick way to create this diagonal spread. Go to one of the expirations, the short or the long, go to the strike price that we intend to trade, and then to buy the one that we intended to buy, that's the 240, we're just going to click on the ask price, right? And how about for this one? It's going to be a net about a $1,500 trade. Let's just do a couple of contracts. Okay? Now, at the same time, we can go up to the expiration for the one that we want to sell. That was going to be our 260. And we hold down the control key on our keyboard and click on the bid price. So we click on the ask price to buy, click on the bid price while holding down the control key to sell, and that adds the short contracts to the long and creates our diagonal spread. So we're going to buy the 240 for the 16th of January, sell the 260 for the 21st of November. Yeah, it looks like about a $15 debit, about $1,500 per contract, about $3,000 net that we're going to be investing in this trade. Now I'm going to click confirm and send. Buying two of these diagonals, 16th of January 2026, 21st of November 2025, the 240, 260 call vertical. The cost here, we've got to remember that there are commissions on the long and the short, both contracts, so $2.60. Let's send that order off and see if we can get this filled. What's this trading for at the moment? 1525 up to 1529. I'm gonna edit this a little bit. Let's say that we're willing to spend up to a net 1525. That's going to be our limit. Now, let's confirm and send. Willing to spend a total of $3,050, 1525 times 2. $3,050 plus commissions. That's how much is going to be invested. That's the theoretical maximum loss of this trade. Could lose that whole value if the stock collapses and we don't get out of the 240 contracts, or we don't get out of the whole thing. Lola says, is there an advantage to selling a higher delta, like the 80 delta? What do you say, selling? You mean for the short call? The advantage would be higher probability. Disadvantage would be smaller premium. So there are pros and cons to those higher deltas. So let's send this order off. See if we can get that filled. 1525 is what we're offering to spend. It's at 1522. We're going to let that continue to work. I think that'll fill. I feel pretty good. We'll get a fill here pretty soon. I might continue to work that order to make sure that we get a fill after the webcast is over, but time for me to let you guys go and enjoy the rest of your day, enjoy the rest of our educational offerings. But guys, this is what we do on Thursdays. We talk about long diagonal spreads and long vertical spreads. Today's a long call diagonal spread, and we're going to see if this works out, see if we can get up toward that 260. That would be the optimal outcome. We'll be talking about, yep, there it is. It filled, got it for 1525. In any case, we'll talk about managing the downside if the stock starts to misbehave. So make sure that you're watching follow-up videos. I think that's a benefit of these webcast series, is we get to see both ends of these trades. But I'm going to let you go. Thanks for watching, guys. Make sure that you're taking advantage of the full slate of educational offerings from Schwab. If you didn't know, let me point out a couple of things here. First of all, if you're new to the channel, welcome. It's great to have you here. If you haven't subscribed to our channel yet, do that right now. It doesn't cost anything. You can go down and click on the subscribe button. But our Trader Talks Schwab Coaching Webcast YouTube channel is where we house these live streams. You can also find our playlist for our previous webcasts. So, for example, if you wanted to find last week's discussion in long verticals and diagonals, you click on playlists here and then just scroll down. My webcast series happens to be down among all of these webcast series. It's right down here in the lower right, long verticals and diagonals. You can click on view full playlist, and you can see that last week we talked about in the money debit spreads. This is a high probability way to trade, but does that make it an inherently superior trade? There are pros and cons. So we talked through those. But great resource there. Make sure that you're subscribed to the channel. Another thing that you want to make sure that you do is follow your favorite coaches on social media. So you can follow Brent and me on X. You can find Brent on X at Brent Moores CS. You can find me on X at Cameron May CS is my handle there on X. And this is a place where I can make posts about developing things in the markets when the cameras aren't on. We can have interaction. If you reply to one of my posts, I can reply right back to you. Great place to connect with each other in between the live streams. But you can also follow me on LinkedIn. So look for Cameron May. This is only within the last couple of weeks. There you go. Just look for Cameron May on LinkedIn. That's what my profile looks like. And you can see I'll post things like I have videos. I post developing events on individual securities, stuff like that. Never a recommendation, just interesting new developments. But a nice thing about LinkedIn, a couple of nice things is, first of all, only about 100 people following me there. So maybe more personalized attention. I don't think so, because I take care of everybody, even on X. But also I can do longer form content here. My comments are just longer. I don't have that character limit that I have on X, so that's nice. In any case, everybody, give us a follow on social media. I'm going to let you go. Go enjoy the rest of your day. I will see you in a future webcast. I'll also look for you on X. Brent, thanks for helping out in chat. Very much appreciated. Guys, whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.